right, so yeah, for the next 45 minutes or so, we kind of talk about some financial implications of state and local tax. I'm Jeff Monsman, Director of State and Local Tax here, leading our indirect tax practice, and with me is Sarah Goldhart, who's the Director leading our income franchise practice. So, over this next 45 minutes or so, we'll be kind of talking about some financial implications, updates as far as what's been happening in tax and kind of how it affect your business from a balance sheet standpoint, things like that. So kind of jumping in right away, sales tax piece, kind of give you guys a Wayfair update a little bit. Still a thing. So 3.5 years later, after the Wayfair decision, kind of update here before we kind of jump into some of the details is all states are officially on board as far as having some type of economic nexus law. Florida, Missouri were the last two states that were late to the party here. So Florida became effective as of July 1st. And then Missouri actually enacted a law in July, but it doesn't take effect until January 1 of 23. So once we hit January 1 of 23, all 45 states that have a sales tax will have some type of economic nexus reporting. Some of the trends that we've seen from the states that have already enacted it is this movement away from the transaction threshold. So kind of the general rule that we've been using on a state-by-state basis really has been kind of $100,000 of sales and 200 transactions, give or take, in certain states. So what we're really starting to see is the focus on that dollar threshold as opposed to the transactional threshold. It's really kind of eliminating some of those micro transactions and maybe some taxpayers who had hundreds of transactions but still low dollar amounts. And it really didn't get kind of to the essence of really what the nexus was kind of big taxpayers who had kind of larger liabilities and the more amount of dollars in the state as opposed to some of the smaller taxpayers. The question we always get to is, so does that mean physical presence is no longer the standard? That answer is no. If you're physically situated in a state, regardless of what your sales are in that state, chances are you're still going to have nexus there. If you're there, benefiting from the services of those states, still going to kind of be taxable, or it's going to be subject to those rules. We're 3.5 years in, so basically what that means now is we're almost full audit cycles into a lot of the states now. So we're going to start seeing a lot of these audit notices coming in. Those states audit somewhere between 3 to 4 years or so. So we're really going to start to see that enforcement and notices and nexus questionnaires. And that even happens after you start your registrations as well too. So you may think, hey, I'm registered, I'm going forward. And a lot of times there's a handful of states out there that even though you registered, they're going to say, hey, what were you doing before? Were you in our state? Were you doing something else? But not to pick on anyone specifically, but we have seen some out of Massachusetts, Wisconsin, and believe it or not, Maine for their 30-person tax department up there. So just kind of some interesting states that are kind of stepping up enforcement there too. And really, some of those nexus drivers will come into play as far as that physical presence prior to that period. So as you kind of start looking to it, and these states all now have these nexus provisions in place, the next step from a business standpoint, an operations standpoint, is to really kind of understand what your liability is. Understanding what you sell, how you sell it, and where it's going to is going to basically, on a state-by-state basis, help you understand where that exposure is going to be. So, take that sales by state, kind of that starting level, and then kind of overlay each of the nexus thresholds, so kind of the state balances of what that nexus threshold is. And then start considering some of the exemptions and some of the customer exemptions, product exemptions to get to what that range of what your risk really is of that situation. You always have to factor in some income and franchise risks and some issues there. Sarah's going to talk to me about that here in a little while, so I'll get out of the way, but there is going to be some of that. And then kind of really look to how far back you want to look. When did you kind of reach that nexus? Did you do anything in any of these other states prior to that economic period? And really kind of create that tiered risk analysis. So obviously your bigger dollars that you're going to own a state is going to need the most attention, and kind of tier it down from there. So whereas you may have some exposure in all these states, the risk just might not be there to, be voluntary exposure in every state, where you might be okay living with a couple $100 risk or a couple $1,000 risk if you just register going forward. So that really is where that action plan comes into place. Is from, and your level of risk is going to be different depending on your company, how big the company is, And basically just the business tolerance for that. So usually it's going to have, there's going to be a mixture of voluntary exposures, go for compliance, and in some states, maybe some inaction to where you say, you know, I'm okay, you know, that I have a small balance, and if it happens, we'll kind of get a little bit from there. So nexus tracking, you know, this kind of just continues along with that analysis. So once you've done that initial analysis, it's not over, right? So you really have to make sure that you're doing this review regularly, constantly making sales. Your dollar amounts of sales in the states may change. They may vary by state, and especially too if you're on a project base or something like that, where maybe one year you have a large amount of sales in a state, next year you may not. So it's always important to make sure that you're kind of tracking all of those sales on a regular basis, because that's really what's going to drive exposure. You know, again, the importance of the transaction threshold is kind of going away, but then the question really becomes what's included in the threshold as far as types of sales. You know, some states will exempt taxable or exempt sales. So if you're selling to a government or a nonprofit or one of those entities such as that, they may not even include those in the threshold. So it's important to know, you know, what that threshold looks like in those states, so that you're kind of getting to the right amount. Gross sales is always probably the best way, because you know you're capturing all of your sales to make that determination. But you know, there are certain ways of sales. You know, the measurement period is also a big thing as far as how these states are defining what the nexus is. Some states will be trailing 12 months, so it is basically a rolling 12-month period to say, if you hit this nexus threshold, if you hit this $100,000 worth of sales in the trailing 12 months, then you reach nexus. Some is the prior year. So basically what you're saying is you may have a whole year free where you may have hit the nexus threshold in that year, but you actually don't have a buy requirement until the next year. And then some states also have it where once you hit that dollar threshold in that year, basically with the next filing period, you now have that buy requirement. So you got to get ramped up, make sure you have your system set up that you can collect the tax and start filing and bidding shortly after you reach the period. So that's more kind of internal systems, ERP type of thing, to make sure that you can actually collect on the tax kind of on a moment's notice. There are some grace periods. So, you know, when you do hit the nexus threshold, these states, a lot of states will have rules written in where it says, hey, 90 days after you've reached nexus, you have to be compliant. So they do understand that. There can be some issues that come into play, but, you know, usually it's once you hit it, kind of make sure that everything's kind of ready for registrations, and some of those issues, just to make sure that the second you're ready to collect a remit, you're filing. You miss a filing at the registration, the notices start coming, they start piling up, and you know, sometimes you're getting buried from day one. It's kind of hard to catch up from there. And so it's really important to kind of create that tracking and reporting process, just to make sure you're not missing anything. You know where your registrations are. If you use a third party to do those registrations, kind of staying in contact with them, say, hey, not only is the registration done, but I set up online to file returns correctly, go from there. So there's steps that do need to be taken even after the registration is complete. Believe it or not, even though pretty much every single state is filed online, they're still sending paper verifications. So you have to wait for somebody to come to the title, and then you have to set up your online account. So there's just some gaps and some periods that you got to worry about in those situations. So with this too, with more taxpayers kind of filing sales tax returns and getting from compliance gain, one thing that's been really more important lately is kind of this concept of exemption certificates. You know, a lot of times if you're only filing in your home state or a handful of states, it wasn't a big deal because you don't have a handful of exemption certificates to worry about. Now it's, you know, it's across the board. So not only filing, you know, 10, 20, 30, 40 states, you're also collecting exemption certificates for the states. So the importance of validating those certificates and making sure there's rules on, you know, how to fill them out, how to make sure they're valid from a state standpoint. Some states will actually have a website where you go validate the exemption certificate and kind of go from there. It's always good to have those up front. If anyone's ever been through a sales tax audit on the sales side, it can be a pain going back 3-4 years for a customer that may not exist anymore to try to get the exemption certificate. depends on the auditor as far as how much leeway and time they're going to give you to get those. So it really is good just to have that process in place to begin and verify everything there, just to kind of create all of those issues there. And kind of make sure you know what the acceptance threshold is to. So, there are some states where you have to go and validate that the exemption being claimed by the customer, they actually qualify for it, whereas some things kind of take it, right? So the example that we always kind of use is, from a good faith standpoint is, the law firm gives you an exemption certificate, says I'm a manufacturer, well, you can't accept that. But, there's kind of a gray scale as far as how far. So just another wrinkle as far as go for sales and use tax compliance that wasn't really there before when it was, just kind of that physical presence piece that's really kind of, we're getting something ahead right now. There are some softwares available, so you can always kind of do a home run if you don't have a whole lot of customers, but once you start getting thousands of customers, it becomes very difficult to track, to maintain, to update, if they expire. So again, just some things to think about as far as how you do a software solution, or if you want to keep that in-house. But again, maintain that document, maintain those files, don't throw them away. Even if customers give you new ones, you want to maintain all those periods, just to manage that risk as you're going through the process. So from the accounting standpoint, that's again real high level. We've given plenty of presentations as far as all implications of waivers. I want to give a little background just so we can get to kind of the accounting impact, basically how to affect your business. Because what we're talking about here, we're really talking about direct expense to your business if you're not collecting and if you kind of go through an audit. So it's always kind of the materiality threshold, right? Larger dollars is going to draw greater scrutiny on those accounts. And with that, within these situations like this, we're going to see more questions from audit teams, both internal and external. So, before when your auditors kind of came out and started talking to you, is like, hey, what do you do for sales tax? Like, well, we don't have physical presence in any of these states. We use third-party shipping. We don't send our salespeople anywhere. It's all online. We don't have to worry about auditors saying, great, awesome. We don't do it anymore. Now we're talking about sales. So we're going to say, hey, sales by state. What are you doing for sales tax? You can't really use that physical presence piece anymore. So it's just another thing that you need to make sure that you're kind of staying on top of through that period and have an answer for it. And the biggest thing would be that if you are having sales in the state, if they are taxable, you're going to have a liability that may be some type of financial booking. So it's more of just more of a question of what are you doing as opposed to I no longer have access in these states. From a financial statement overview, the biggest thing here is you have to review your compliance with the law. So you kind of alluded to that a little bit as far as, I know I'm a physical presence. Did I hit the threshold? And if you do, that exposure now exists. So when an exposure exists, you have to record that accrual when the exposure is probable and reasonably estimable. And right now, because of the waiver laws, because all these states have as close to black and white rules as you're going to have in tax, it's easier than ever to basically beat that standard and come up with the number. So when you don't actually know what that range is, so you have to determine the ranges, and when you don't know that exact number, there's going to be product exemptions, there's going to be customer exemptions. So when you kind of take care of, you do the analysis, you're going to come up with the high end, low end. The rule here is to book the low end of the range, unless there is a better number between. And so what we mean by that is we may know that certain customers are exempt, and you're selling to a manufacturer and it's an input in their manufacturing process. You can kind of throw out certain vendors even though you may not have an exemption certificate. So you can engage a sales tax team to do the research and come up with a more correct answer, just so that you're able to book the correct number in that situation. And that impact really is, it affects the earnings, affects the balance sheet, and if you are booking reserve, the next question becomes, when can you release that reserve? So there's audit look back periods from a tax audit, tax audit, there's going to be a look back period where basically if you book a reserve for say 3 or 4 years, as you get in compliance, if you haven't done anything to clean up that liability, through the passage of time, the statute of limitations for these audits do fall off. So there can be some time to release that reserve where basically what's happening is those dollars aren't getting reinstated. You can't really get audited anymore. And so those dollars can back, get off balance sheet back. So just understand when that timing is, understanding voluntary disclosure periods, and essentially when states can go back and assess those taxes are very important. So as you're performing that analysis, the biggest thing is documentation. So not only are you kind of preparing the spreadsheet and the exposure analysis from that standpoint, you're creating a memo, right? So not limiting tax, reason why, creating a memo for kind of your position as to why you're not doing that as important. So you can really document that file and have that audit ready file, just so when the state does come in, you kind of know that there's no scale clause, you know what that liability is, you may have that number booked up. And then again, financial statement impact on that one again, it really comes down to material. What's your business's materiality to book that accrual, and then go ahead and do that, and then basically find that balance. I think the biggest takeaway here from this slide is basically that materiality, especially with changing in sales value, can change quick. So it can't just be a one-time only analysis, kind of put it away, never have to worry about it. This is kind of a moving fluid document to say, all right, my sales are increasing. What do I need to do in this state? Is there anything I need to do in this state to kind of continue to have that conversation? Because as you grow, as businesses grow, chances are your footprint's going to get bigger, and that materiality is going to change as well too. So just knowing what that is, so that you can kind of look at that way is very important. So from that standpoint, that's kind of the high level on the sales tax and the Wayfair piece of it. I think it's the biggest takeaway of that is Econ Connects is here to stay. It's like the internet. So yeah, I think it's always going to kind of pay attention that way to make sure that you're staying on top of it. So kind of another hot topic that we've seen here in the past couple of years is really kind of due diligence on mergers and acquisitions, and what items can come up during these types of transactions. We've gone through quite a bit of these recently in the past few years. It almost seems like a majority after we get past all the financials and the quality of earnings and all that stuff, the tax question always goes to the SALT world, just because there's thousands of jurisdictions throughout the country, and they're focused on, the buyer's focusing on managing their risk, and the seller is focused on maximizing what they're getting out of it. So from this standpoint, we just want to kind of talk about a few things as far as preparing for the transaction, as you're going through the transaction, and also some kind of post-transaction items as well too, and some considerations as far as what tax issues may pop up from a SALT standpoint, because quite frankly, that's what most of the issues are on transactions. So when you're preparing for it, on the sell side, it really kind of goes back to just preparing and knowing what your business is doing and where it's doing it, so that you can get ahead of any potential issues. Kind of doing a self-review, a self-audit, and say, all right, here's where we're filing, here's kind of our established footprint, and where else can we go from there as far as what our issues are. That includes gathering information from not only audits and EDAs that you've done, but any internal studies and memos that you've done. So maybe you think you may have exposure somewhere, but then you say, oh no, I have this memo here that says, here's why I can file these returns. So basically just gathering all of your files ahead of time before you turn everything over, and even before you're even in the process where you've gone to market, just so that you know kind of what's sticking out there. So if you do discover something before going to market, you can always kind of consider getting ahead and mitigating that exposure ahead of time. Doing voluntary disclosures, prospective filing, amnesty periods. We found over time that if you think you're a couple of years away from going to market, getting ahead and doing that voluntary disclosure, so that when the buyer comes in, they say, hey, we want to see your tax filings. Hey, Rick, we did these 10 DDAs for sales taxes. Don't even worry about it. We got this letter letting us out, but basically closing the DDA, they're not going to look back at these periods. It's kind of your get out of free card. So it's always good to say, we're going to clean these exposures up so it doesn't hit the escrow, doesn't even reduce the purchase price, doesn't create any issues on that. And then also too, it just goes through as far as documenting tax and nexus position, so if you aren't filing somewhere, you know exactly why. If you market, so you have your answer say, hey, we think you should be filing here. You say, no, you don't need to file here. Why? And on the buy side, it's the same thing. You may be getting into a foray that is completely different than what your current business operation is. So you need to understand the industry of your target to know what that means from a tax perspective. Software vendors have a very different role than manufacturers make from sales or franchise tax perspective. And so it's really important to know, is the product even taxable? Is the service taxable? Do you have nexus? Kind of what are all these questions and issues that you need to kind of hit just to make sure that you know what to look for when you're kind of your target. So I'm happy to talk let Sarah talk a little bit on that.
Yeah, but really on the income franchise side in due diligence, I mean, it's a lot of the same things that Jeff would be looking at on the indirect side, on the sales tax side. And Nexus is a big thing that we look at. What's the footprint of the company? Where are they doing business? Where are their sales? Where are their people? That kind of thing. Are they taking certain positions on their income tax returns regarding Nexus, EL 86272, which I'm going to talk about here in a little bit. We also look at apportionment. That's a big thing on our side. Is looking at the apportionment schedules if it's a multi-state company. Again, it all comes down to that footprint. Where are they doing business, and where could there be, where could there be exposure potentially or risk that we need to analyze and watch out for. And then also just looking at the returns, if they are filing state returns, it's looking through those to see how are they filing them, are they taking credits, what again, are they taking any type of position on maybe a state adjustment that we need to look at. So all of that goes into the due diligence process. And as Jeff said, there's always something, it seems like, on the state and local side to dig into, especially if it's a multi-state entity.
So once we kind of get during the transaction, that's where we kind of either entered the LOI or we're at a point where we're kind of really digging into the details of it. And this is really from the buy side, this is absolutely your opportunity to resolve all unknown tax issues. If you're the buyer, this is your chance to basically say, hey, listen, we have almost one bite of this apple to get what we need to get and understand where these exposures are. Because once the deal's done, once all the agreements are in place, chances of going back to the buyer and saying, oh, wait a second, we made a mistake outside of some major breach, it just doesn't really go well. So this is where you kind of get everything out on the table. And that's why when you're on the buy side, if you're doing exposure calculations and you're kind of throwing it over to the other side to the seller, that's where your exposure calculation needs to err on the high side, as opposed to, it's your business one kind of lower side of this year. You're saying, nope, this is where we think that you start factoring in interest, penalties, and anything that could potentially go wrong, because like I said, you need to be able to cover everything after the deal's over and after completion is done. On the sell side, it's going to be the exact opposite. It's like playing defense here. So you've made these decisions, you know your business, there's probably some valid reasons as to why you made the tax law decisions that you did. It's time to defend them. It's time to say, here's why we did it, here's kind of our back. Sometimes it can get a little contentious, but at the end of the day, usually it's kind of a situation where both sides, buyer and seller, you want to get something done, so you kind of reach that happy medium. But that's where you really want to kind of identify those errors of the exposure calculation on the high side, where they're gonna do a look back of 10 years. You say, no, it's really only a 5-year look back. You kind of start breaking down the details there. And then again, it really becomes the materiality of that exposure, and then kind of understanding how we want to handle that purchase price reduction, if that's what it is, or if there's something that can kind of escrow and kind of get to the details of how you want to handle those, how you want to earmark. Actually, sorry, post-transaction, just want to hit a few things in the post-transaction, especially on the exposure mitigation. So a lot of times this exposure mitigation will be handled by the buyer, and it will kind of be coming out of whatever's in the escrow, or if there's an insurance policy. It's important for the seller to still remain involved to protect their own interests, right? If the seller is doing voluntary disclosure or taking care of past tax liabilities out of an escrow, something like that, the seller is motivated to be involved in that process. Because buyers would say, hey, we've got $2 million of escrow. If we happen to go through this audit, it's a $500,000 thing, we're good at that escrow, so covered. We're not paying for it. The seller, but oh, it's coming out of my pocket. So it's just good to kind of at least be consulted and be involved and kind of know how that business is going. So it's something interesting to think of that standpoint. You think of once that deal is done, you kind of go away, but the seller still kind of hang out and be involved with it. The go forward process, compliance piece is always something that needs to take care of too, as far as do you consolidate filings? Do you still maintain separate entities and understand how that go forward structure is going to be from a tax standpoint? So eliminate duplicate filings, kind of is that nature. And just know you got a whole brand new business coming in, and basically what can you consolidate to make it slightly easier? And then again, some more of the accounting and financial implications. The biggest thing is the unforeseen tax exposure can increase the escrow. And you need to understand how long that timing amount of the escrow is, what's covered, does it cover just the liability, are the professional fees going to be paid out of there? Is there an insurance policy that's involved as well too, that's got to be separate from the escrow? Does this reduce the purchase price then, or does it just affect kind of modification of the earnout if there's an earnout as part of that? And then kind of the last piece too is if a tax issue does terminate a deal, likely there's a financial statement impact to where now you're you're out of the deal. You probably got a tax exposure that you know about, that there might be something that needs to be booked from an accounting standpoint. So it's not, hey, this deal is over, we'll go look into the next one. You probably have some type of accounting piece that you need to hit as well too. So just a couple of things to think about from the SALT standpoint as far as M&A activity. You hear a lot about earnings and hear a lot of stuff about that, but that tax piece is really important to hit kind of during that end as well too. So that's that on the M&A stuff. Alrighty, and with that, I think we're going to jump to some income franchise specific issues.
All right, thanks, Jeff. Yes, I think Jeff mentioned I'm Sarah Goldhart, Director in the State and Local Tax Department, and I specialize in the income franchise area. That's what I'm going to talk about here for the rest of our time. And there's definitely a lot going on right now in the income tax space. A lot of very big concepts, big changes coming, a lot of discussions being had at the state level, or among the states and some other organizations, in particular about income tax nexus. And so we're probably going to see a lot of developments in that area over the next few years. I think now that the states have kind of all dealt with Wayfair on the sales tax side, now it's time for them to dive in on the income tax side and try to chip away, I think, at some of the income tax rules. So the first thing, thank you. So I'm going to talk first about Public Law 86272. If you deal at all with state income tax, probably recognize this term. It gets thrown around a lot. 86272 is actually a federal law. It was enacted in 1959. So okay, you can tell right there, it's old, and things have changed a lot since 1959. But it seems really straightforward. It's a federal law that prohibits a state from imposing income tax, the state income tax, on an out-of-state company if that company's activities in a state are only limited to the solicitation of sales of tangible personal property, and those orders are approved and filled from outside of the state. So that means if you're selling pencils, widgets, tangible property, if your only activity is having a salesperson go in there to solicit orders, that state cannot impose its income tax on the company. So for a lot of, especially the manufacturers, and there's a lot of companies out there, 86272 is really the lifeline, is what they depend on to not have to file and pay income tax in a lot more states than they do, if that's their only activity. But as I mentioned, this was enacted in 1959. There's been a lot of talk about 86272 just because times have changed. The internet, obviously, the way people do business has changed over the years. There's lots of ways to reach customers now besides physically going to that state to solicit or even to perform services, you really don't need to physically be there anymore. So over time, there's been a lot of talk about 86272, and recently the Multi-State Tax Commission, which is it's an intergovernmental state tax agency that really, the states take on various degrees of membership in this agency, but they work together to get the state's opinions, to work for both the states and taxpayers to try to make sense of some of the state tax laws and provide some uniformity across the laws and across the states. They issued, back in 1986, they issued their first statement on 86272, where they tried to provide some guidance on what exactly constitutes, a protected activity. It's a simple statement, but there's a lot that goes in there. And the statement from the MTC years ago tried to provide some guidance on what is an activity that's okay, that's still going to protect you from tax, and what's not okay, what's considered unprotected. So over the years, the MTC has been looking at 86272. They've kind of changed the wording, changed their guidance on it over the years, but really recently in August was when they made some substantial changes to their statement on it. And they've added a section now on activities conducted over the internet, which is huge. And there's actually examples listed from a business side of looking at things. It's obviously not very business friendly, and I'll give you a couple examples here. But that's the biggest change, was adding those examples now on internet activity and what constitutes, unprotected activity. So again, even though you may not be physically going into a state, if you're doing these things, you may now be subject to income tax. The guidance from the MTC is not automatically adopted by the states. They actually have to go in a lot and adopt it. We haven't seen that yet, but I'm guessing it's coming. So, it's definitely something to be aware of. We're going to watch how the states interpret this. If Congress is going to step in and take action, that's also been something that's been talked about even since Wayfair, is what's going to happen to 86272. But this statement really does, change a lot of things. And I put a couple examples on the following slide to give you an example of what they consider still protected, which is okay, the first one, and the second one, which is not. So the first one, they talk about, if you are providing post-sale assistance to a customer, but you're just posting a list of FAQs, for example, on your website, and then envision the customer has to go to the website and sees that static list of FAQs. That does not defeat 86272 immunity. They don't consider that an activity happening in that other state if that customer just happens to go online and looks at the company's FAQs. But number 5 in the example list, the second one on our slide, talks about internet cookies, and that if the business places an internet cookie onto the computers or devices of customers in that other state, and that those cookies are gathering information, searching information that they're going to be using to identify new items to offer for sale, basically research, that's going to be an unprotected activity, and it beats the business purpose immunity of 86272. So that one I think is huge because anymore you go to a website, you automatically, it seems like, get the cookie message, and that's just how companies operate now. So I would say that's something. The changes to 86272 are coming. If the states adopt this, it could be very impactful to a lot of companies that rely on it to not have to file state income taxes. So again, it's something that we're going to be monitoring over the next couple months, but it's not entirely surprising, I guess, with, again, the change in the way companies are doing business since 1959. So stay tuned on that front, but definitely something to keep in mind. We have the CPE code here too, our 17th and 18th activity code words are tax and entity. So the kind of the next big thing in the income tax world, which is more for the pass-through entities, I know we usually have a mix here, pass-through entities and corporate corporations, but this one is specific to the pass-through entities, but it's been in the news a lot lately. And it's the enactment of what are called these pass-through entity taxes, which are actually entity level taxes that the pass-through entity pays. You know, pass-through entities typically pass through the income to the owners, and the owners are the ones that ultimately pay the income tax. These newly enacted taxes are almost like treating a pass-through entity like a C corp, essentially, where the entity itself pays the tax. And this is all because of the SALT cap from a few years ago in the Tax Cuts and Jobs Act, the SALT cap that said that an individual was limited to deducting $10,000 of state and local taxes on their individual return. It's an itemized deduction. So if you remember the past few years, you know, when the SALT cap first came around, you know, a lot of the states, especially those in the Northeast, the higher tax states, kind of went a little crazy and were filing lawsuits and were, you know, they spent years trying to figure out workarounds of the SALT cap. And they did. They came up with this pass-through entity tax. Connecticut was one of the first ones to do it. And then, you know, there's a lot. So if you see the list, I mean, there's not of states that have all reacted and enacted these pass-through entity, the entity level pass-through entity tax. And now we've got Ohio following suit here. There's a bill out there. It's in committee, SB 246. Where we've also proposed, or Ohio has in committee a pass-through entity tax at the entity level. So again, the function of these is to allow the entity to deduct all of the tax and essentially reduce the taxable income of the entity and pass that along to the owners. So the entity pays the tax and gets the full deduction. So again, all around the SALT cap and getting around that. I read actually the other day that so far though, all of these taxes that have been enacted, the participation rate is like 8%. So it's still pretty low. I think there's a lot of people that are just totally confused, trying to figure out, does this help me? Like, what is this? And the departments of revenue really have not been, some of the guidance is not that great. So I think we'll probably start hearing a lot more about it, but it's also dependent on obviously the SALT cap, because if you've been following any of the recent legislation, the next bill coming through Congress, you know, the SALT cap is still up in the air. So if that goes away or if it goes up, you know, that really kind of makes some of these taxes a moot point. But, you know, a lot of the states jumped on this because, you know, they can say, hey, we're doing this to help our residents, you know, to save money and ultimately they can help, you know, help the individuals save money. But it's really fact specific. If you're hearing about these or thinking about your entity and whether these would be helpful in these states, you know, to use specifically, it's really fact specific. It depends on the state. It depends on, you know, where the owners reside, in what states they're residents of. Because there are some nuances to these where they may seem great, but at the end of the day, some of the math doesn't always work out for as much of the savings as maybe they initially you would think there would be. So, so this is another area to kind of stay tuned because we don't know what's going to happen to the SALT cap, but the news on these taxes just keeps coming. So, and you know, I mentioned Ohio. There's 3 more being proposed. Our neighbors over in PA and up in up north, they've got one proposed. So, so if you've got a pass-through entity, I would definitely keep it on the radar, but know that, you know, that these are very fact specific, and you really have to get into the numbers to see if there's really savings there. So another big topic, obviously, that we've seen over the past 2 years in particular is the impact of having remote employees, people working remotely. When we go back to, you know, this was kind of happening even before COVID, where, you know, the remote employee environment, we started to see, you know, We started to see that quite a bit, and of course, obviously with COVID, it really took off. So last year, during those quarantine periods, some states did release official income tax nexus guidance on whether having these people temporarily in their states would cause income tax nexus. So meaning, does that subject the company to a income tax filing just because they have these people sitting there, maybe working temporarily due to COVID? A lot of those that even put out guidance said, no, we're almost like gonna pretend COVID is not even happening. We know that they're temporary. We're just gonna go with the regular, kind of the standard laws, and, once this subsides, this will all expire. Not all the states though did release guidance, so we just didn't have guidance from everyone. But I think most tried to take the position that, this was temporary. But now we're seeing, obviously this, while some of the COVID remote working still is going on, a lot of companies are just hiring remote employees in other states where maybe they didn't have employees before. And I mentioned, the MTC statement earlier on 86-272. The other big thing that they added to that statement was actually a bullet point on remote telecommuters. And it does say that if you have a person telecommuting regularly from within a state, unless that person is a pure salesperson selling tangible personal property, then if not, that does create nexus. So even if that person maybe not interacting with customers, if they're doing back office work, having that person there creates nexus. So you really have to think about that from a tax perspective when you're hiring remote employees, just to understand, at least have that understanding of what the tax impact is, so there's no surprises later on. I mean, in some cases, we've seen companies have hired remote employees, but if they don't have any sales in the state, and maybe that state's apportionment is sales only, they may have nexus but no actual tax due. But those are the kind of things you should be analyzing when you hire somebody remotely, again, to make sure if there's any tax impact, just so there's no surprises later on. As far as when you hire remote employees, I'm not going to get into withholding too much, but I did want to point it out because the withholding rules are really where it all starts when you hire remote employees. And that's the thing, a lot of companies will say, well, I'm going to hire, I've registered. Okay, so you've registered for withholding, you've registered for unemployment, and now what? So, what does that mean for sales tax? What does that mean for income tax? So, that's kind of always that first thought is I'm going to register for withholding. But again, it's good to understand, before you fill out that registration, that withholding registration, and say who you've got, what they're doing, where in the state they are. A lot of times you have to put the address, and that pull in a local filing. It's really, you just want to make sure that you're thinking about, what does it mean from an overall perspective? Is that person going to be there temporarily? Is this a permanent position? Some of the states have some other withholding rules that you even have to consider, depending on if somebody may live in one state, but you still have to withhold in another state. So again, it kind of highlighted these things, and I wasn't going to talk too much about withholding, but it is something to think about because that is the first thing that everybody does is register for withholding, and then that can start the chain. And some of the states did put out guidance last year related similar to income tax related to COVID. Due to COVID remote work, a lot of that has expired now. But you really want to make sure you're understanding the entire nexus position before you make that hire. And also the local level, because sometimes the local rules can be different than the state rules. So something to keep in mind.
A lot of those state registrations make it really simple for you to register for too many taxes. So you basically you're registering for just withholding or just sales tax because it's a combined reporting. And, you can end up registering for a bunch of taxes that you're not subject to. So.
Right, no, that's a good point. Yeah, those registrations are dangerous for sure. So I guess as far as what's next on this front, and it talks a little bit in that first bullet point is too, when you have a remote employee, they may also impact, keep in mind, your income tax apportionment, because all of a sudden now you have a payroll factor. And you may have a state like Virginia that says, as long as you have a factor, you have nexus. So, again, something to consider that there's income tax implications as well with remote employees. Overall on Nexus, I mean, as a result of Wayfair, some of these budget shortfalls due to COVID, I mean, we're probably gonna see the states be more aggressive. And so that's also why, you've got people out there, you just need to be able to understand kind of what it all means. We'll probably see an increase in state Nexus questionnaires, which are also landmines for sure. So we always like to help with those or review those before submitted. But you really may need to evaluate if you're taking a no Nexus position in particular in a state with a lot of activity, you probably want to look at it because there could be financial statement implications, especially with ASC 740. So we recommend, with all of these kind of this changing environment, that would be something to take a look at. And again, understanding the impact of the telecommuters. As far as economic nexus goes, and that's kind of just the last piece in the nexus discussion. Like I said, there's a lot going on in this area right now. Jeff touched upon, Wayfair and what it did, economic nexus on the sales tax side. This idea of not having to have physical presence on the income tax side has really been around a long time, back to like the old Toys R Us Jeffrey case back to 1993, where they said you didn't have to have physical presence to be subject to income tax. Interestingly, I think all of us in income tax used to say, well, we kind of used to depend on that case Quill to say, well, Quill says you got to have physical presence. And now after Wayfair, we're all saying, well, no, that was a sales tax case. We never called Quill. So more and more the states are probably trying to chip away at Nexus in this regard too, as far as just setting those economic bright line standards to say, if you have this amount of payroll, this amount of property, or this amount of sales, you've got Nexus no matter what. So you don't have to be there, as long as you hit those thresholds, you're gonna have Nexus in our state. We've seen a lot of states already kind of go down that path. I've highlighted some on the slide of the ones that have already have those Nexus standards where it's just based on the amount of either property, payroll, or sales in a state. I know a lot of folks are always familiar with California. That's kind of the one everybody knows. If you hit a certain level of sales, you're in out there. And it's not a very high number. So, and Ohio went through this. Ohio has a CAT for CAT purposes, that economic threshold for 150,000 before you have to register and file, and 500,000 if you're an out-of-state company. But that was challenged here in Ohio a few years ago. But it was determined that the state can use that requirement, substantial nexus requirement, for taxpayers to have to file Ohio CAT. So that's something we're probably going to continue to see more of, again, especially since Wayfair. We've already seen a couple of states directly react to Wayfair, like Washington. They reduced their nexus standard for the B&O tax to match the sales tax standard. We also saw Hawaii enact the first sales or transaction nexus standard for an income tax. And again, that was in response to Wayfair. So you can kind of see the trend in some other states that developed the income tax nexus threshold. The trend here is, again, they're all just trying to chip away at nexus. And, so it's definitely something, again, that there's just, as they do that, they can have substantial financial implications for your business. I mentioned 86272 earlier in some of the changes. I just also like to remind folks when we talk about Wayfair that PLE 6, while it's changing and it's under debate, it is still around. It is still the rule. For income tax purposes, Wayfair does not overrule 86-272. It still remains, so even if you, hit a threshold for Wayfair purposes, or even these economic nexus thresholds, if you have 86-272 protection, you're still protected from income tax. So that, remains in place, but we will have to watch it over the next couple of years and see, see if what happens with the MTC statement, what happens with if Congress will take action. That's probably less likely, but it's possible. There was a bill out there a couple of years ago to actually broaden 86-272 and make it apply with more things and actually some services, but it's been stalled, I think now for about 2 years. So, but who knows? It could come around again, but it is out there. So a lot of different changes in the works to be aware of. And then lastly, here in the last minute, I just highlighted on this slide some closing things to be aware of as you get into your 2021 income tax compliance and looking even or ahead to 2022, things to keep in mind from an income tax perspective. You want to review for apportionment changes. A lot of the states now have moved to single sales factor apportionment, meaning when they slice up taxable income in the different states, they can rely on payroll, property, and sales to do that. A lot have moved to sales only, but some still use 3 factors. Some still use all 3 factors. Some have been doing phase-ins of certain percentages. Alabama is one that's moving to single sales for 2021. So again, you just want to be looking at your apportionment percentages because it can make a big difference, especially moving from 3-factor to single sales. It can result in a significant spike in your apportionment percentage and potentially an increase in tax. Reviewing each state's rules on the taxability of the COVID-related programs, they all are all over the board on that. So if you have PPP, ERC, any of these programs, you really want to just make sure you're looking at each state's rules to see if there's any nuances there and how to treat those for state and for the localities as well. We've seen a lot of states change their rates the past year or two, or will for 2022. Actually, a lot have lowered their corporate rates and trying to be more competitive, their corporate or their individual rates. So watch out for that. We've seen a few states that will, for the next couple of years, be limiting the amount of NOL carryover deduction that you can use. So we saw this back during the recession. States do this quite a bit during down financial times where they'll tell a company, even if you have a net operating loss carryover, you can't use it. We'll let you extend the time, kind of push it out and let you use it in the future, but you can't use it right now. So again, so the states can make some more money. And then lastly, just wanted to highlight that Connecticut, if you have outstanding liabilities there, they're offering an amnesty program right now through January 31st. So amnesty programs are a way to come forward if you've got some outstanding liabilities. They're usually not as favorable as a voluntary disclosure program, but it is out there and something to consider. So right on time. Anybody has any questions?